Welcome to Breaking News to Trading Moves.
Great to be here.
Our mission today is, well, to look past the political headlines coming out of Japan and really focus just on the financial side of things. Specifically, how a major leadership change there might translate into performance for stocks listed right here in the U.S.
That's exactly right. We're examining the market's reaction to the selection of Sanae Takaichi as the new leader of Japan's ruling party, the LDP, and from there, tracing how the money flows, how competition changes, and how currency moves could affect potential winners and losers on the NYSE and NASDAQ.
Okay, so for you, the listener, the goal is clarity on the actual financial mechanics involved.
Precisely.
So the core event driving all this is the LDP electing Sanae Takaichi as its leader, and this positions her to become the next prime minister. A change like this in Japan, especially with the LDP, always gets a lot of attention, doesn't it? Because of what it might mean for economic policy.
Absolutely. And the immediate market reaction in Tokyo was, well, it's quite striking, really quite aggressive.
How so?
We saw the Nikkei 225 index just surge. It hit fresh records, with gains settling somewhere around 4 to 5% in that initial period.
4 to 5%, wow.
Yeah. And at the same time, the Japanese yen, the JPY, came under immediate pressure. It weakened against the US dollar or the USD by roughly 2%.
Okay, so that's a pretty clear signal. Stocks up sharply, currency down.
Right.
It tells us what investors were thinking, right? What were the sort of core expectations the market priced in almost instantly?
Well, the markets seem to factor in two main things, and they kind of complement each other. These came from Takaichi's known policy ideas and, the LEP's general approach.
Which were?
First, a big expectation for a substantial fiscal stimulus, government spending to try and kickstart the economy, maybe more borrowing, more spending programs.
Right, stimulus.
And second, the market assumed a continued commitment to the very easy, accommodative monetary policy from the Bank of Japan, the BOJ.
So keeping rates super low.
Exactly. Keeping that dovish stance, likely to support any government spending efforts. It makes borrowing cheaper for the government, too.
And the strength of that Nikkei move, that 4 to 5% jump, suggests a lot of conviction behind those assumptions.
It certainly seems that way, a very strong initial read from the market.
Okay, let's look a bit closer then at the reaction within Japan's market before we connect it across the Pacific. Which specific sectors or themes did well right away and which ones maybe lagged behind?
Yeah, looking inside the Tokyo market gives us some clues about the specific policy bets. 3 broad themes really stood out as outperformers immediately.
What?
Defense-related stocks, semiconductors, and this broader category often called economic security. These areas saw pretty fast and forceful gains right after the announcement.
Defense, semis, economic security. And what got left behind in that initial rush?
Japanese financials. They were pretty clear underperformers in that first phase.
And the thinking there is?
It seems pretty direct, linking back to those policy expectations. Takaichi is seen as favoring more defense spending and policies to strengthen Japan's tech independence. That obviously helps defense and related tech sectors.
Okay.
But conversely, the markets bet that the BOJ will stay super dovish, keeping rates near zero. That's generally bad news for banks and financial firms. They usually need higher rates and steeper yield curves to make more money on lending. Their net interest margins suffer otherwise.
Okay, that sets the scene in Japan really well. But the big question for our listeners is how this translates globally. How does this mix a new leader pushing for spending, a weaker yen, stimulus bets in Tokyo, how does that influence companies listed here in the U.S.?
Right. We need to break down the two main ways this transmits across the Pacific, and sometimes they actually work against each other. The two key forces are that weaker yen versus the dollar and the potential effects from the expected Japanese stimulus spending.
Okay, let's start with the positive side, the beneficial effects. How does stimulus money spent in Japan actually end up helping U.S. companies?
Well, when you have a weaker currency combined with the government planning to spend a lot, maybe on things like infrastructure, technology, defense, it can really redirect global capital.
How so?
U.S. companies that are part of the supply chains Japan uses, especially in areas like advanced tech, specialized materials, or defense equipment, they can see increased orders. That Japanese stimulus spending doesn't just stay in Japan. Some of it flows out as they buy advanced goods and services from American suppliers.
So it's about procurement, buying stuff from the U.S.
In part, yes. And beyond that industrial flow, there's a more direct consumer angle, too, especially for things like travel.
Ah, right. You mentioned the weaker yen.
Exactly. Think about U.S. travel platforms or airlines. A cheaper yen makes Japan instantly more affordable for American tourists.
Right, your dollars go further.
Precisely.
Yep.
That might drive up demand for trips booked through U.S.-based online travel agencies, OTAs, or for seats on planes flying across the Pacific to Tokyo or Osaka. It's a direct currency incentive, potentially increasing business for the U.S. companies that handle that travel.
Okay, so that's the positive flow. Stimulus driving procurement, weak yen driving tourism. Now let's tackle the other side, that concept you mentioned, translation headwinds. This sounds important, especially for potential losers. Can you break that down?
Yeah, translation headwinds are basically just a currency math issue, but they can have a big impact on a company's reported results. It happens when a U.S. company earns a lot of revenue in a foreign currency, like the Japanese yen, but has to report its overall results in U.S. dollars.
Okay.
If the yen weakens against the dollar, when the company converts those yen earnings back into dollars for its financial statements, the dollar amount ends up being smaller. It compresses the reported numbers.
Could you maybe walk us through a quick example, just to make it concrete?
Sure, let's keep it simple. Imagine a U.S. tech company sells something to a Japanese customer for, say, 1,000 yen. If the exchange rate was 100 yen to the dollar, that 1,000 yen is worth exactly $10 in revenue for the U.S. company's books.
Okay, simple enough.
But now, let's say the yen weakens after this news. Maybe it goes to 105 yen per dollar. That same 1,000 yen payment, when converted back, is now only worth about $9.52.
Ah, I see. Less dollar revenue for the same amount of yen.
Exactly. That difference, almost 50 cents in this small example, gets multiplied across potentially millions or billions of yen in actual revenue. It pushes down the reported sales figures, and crucially, it can lower the earnings per share figure just because of the exchange rate movement. It's like a profit cut purely from FX.
Got it. That's a really clear explanation of translation headwinds.
Yeah.
Okay, with those two mechanisms, the positive flows and the negative translation effects laid out, let's look at the specific groups flagged as potential winners. Beneficiaries of the stimulus hopes and the positive mood in Tokyo. We can start with the most direct way to play the Nikkei surge, U.S.-listed ways to invest in Japan.
Right. The logic here is pretty straightforward. Tokyo stocks surged on those stimulus expectations, so U.S.-listed funds that track the Japanese market automatically benefited from that upward move.
Okay, and we have two specific examples flagged here, but they sound quite different. The iShares MSCI Japan ETF, ticker EWJ, and the Wisdom Tree Japan Hedged Equity ETF, ticker DXJ. What's the really critical difference between EWJ and DXJ that listeners need to understand?
The key is right there in the name of DXJ, hedged equity. EWJ gives you straightforward exposure to Japanese stocks and to the yen's value. So if the yen keeps weakening, like it did initially, that currency drop actually subtracts from your returns when the fund's value is calculated back into dollars.
Okay, so EWJ gives you both stock moves and currency moves.
Correct. DXJ, on the other hand, uses financial instruments like currency forwards specifically to try and neutralize that JPY to USD currency risk.
Yeah.
It aims to strip out the effect of the yen's fluctuations against the dollar.
So if the whole idea is based on strong Japanese stocks but a weak yen, which seems to be the Takaichi bet, then the hedged approach, DXJ, seems like the better fit.
Logically, yes. If you believe the weak yen trend will continue alongside strong stocks, DXJ is designed to capture just the stock market gains without being dragged down by the currency's fall. It lets you isolate the Nikkei rally from that negative translation effect that hits EWJ.
That makes a lot of sense. Okay, moving to the second group of potential winners back to the policy side, U.S. defense and aerospace suppliers. This seems tied directly to expectations about Takaichi's priorities.
Exactly. The thinking is based on her known stance. She's seen as strongly advocating for, well, significantly higher defense spending, and also for deepening the security ties between the U.S. and Japan, particularly with regional tensions being what they are.
And that political stance could translate into actual orders for U.S. defense companies.
That's the connection. The main channel is through what's called foreign military sales, or FMS. These are essentially government-to-government deals where the U.S. government helps sell American defense equipment and services to allies like Japan.
So if Japan decides to spend more on defense,
a good chunk of that spending could flow to U.S. prime contractors through these FMS programs. Japan is already a major buyer of advanced U.S. military hardware.
right, and the analysis points to a couple of specific U.S. giants here.
Yes, the focus is on Lockheed Martin, ticker LMT, and Northrop Grumman, ticker NOC.
LMT and NOC.
Right. These companies are big players in things like missile defense, advanced fighter jets, sophisticated radar systems, exactly the kinds of capabilities Japan often prioritizes when it looks to upgrade its defenses. So any concrete announcements about joint programs or new purchases under the new administration could be a direct revenue plus for them.
Okay. The third category of winners seems a bit more straightforward, maybe more consumer-focused. Travel and online booking platforms here in the U.S. This sounds like it's purely about the weaker yen again.
It really is the most direct currency play, kind of arbitrage. That weaker yen makes everything in Japan cheaper for Americans holding dollars.
Like that hotel room example. Yeah.
Exactly. A $1,000 hotel room effectively costs less in dollars if the yen drops. Or, put another way, your dollars buy you more food, souvenirs, experiences once you're there. It lowers the financial barrier to taking a trip.
And that boosts demand for the U.S. companies that facilitate the travel.
Absolutely. The clear examples given are Booking Holdings, ticker BKNG, and Expedia Group, ticker EXPE. These are the big online platforms where many people book flights and hotels.
BKNG and EXPE.
They capture those initial bookings. And the benefit would likely extend to the major airlines selling those long-haul trans-Pacific flights, too. More demand for seats as the overall trip cost comes down for U.S. travelers.
Okay, that covers the potential beneficiaries pretty well.
Yeah.
Now we need to flip the coin and look at the companies that might face challenges because of these dynamics, particularly due to that weaker yen. Let's start with U.S. auto manufacturers who compete directly with Japanese brands.
Yeah, this is a classic currency competition issue. When the yen weakens, it gives Japanese automakers like Toyota, Honda, Nissan a real advantage when they sell cars here in the U.S. market.
How does that advantage work? What can they do?
They essentially have two options, and both put pressure on the Detroit automakers. First, they could just keep their U.S. prices the same, sell the cars for the same dollar amount, but when they convert those dollars back into yen, they make a bigger profit margin because the yen is weaker.
Okay, so they just pocket the difference.
Or, second option, they could use that currency cushion to actually lower their U.S. sticker prices a bit. Maybe not by much, but enough to try and steal market share in very competitive segments here, knowing that the weaker yen still protects their profits back home in Japan.
And either way, that's tough for the U.S. incumbents.
It is. We're talking about companies like Ford, ticker F, and General Motors, ticker GM.
F and GM.
Yeah.
Where would they feel that pressure the most, do you think?
Well, potentially across the board, but it's often sharpest in those high-volume, price-sensitive areas. Think about compact cars, mid-sized SUVs, maybe some trucks, where the American and Japanese companies go head-to-head very aggressively. Even a couple % move in the yen gives the Japanese firms an immediate cost advantage that Ford and GM find hard to match without hurting their own profitability.
Right. Okay. The second group of potential losers is the one that links directly back to that accounting issue we discussed. U.S. companies with large revenues denominated in yen. This is where those translation headwinds really bite.
Exactly. These are companies that earn a significant chunk of their money in Japan doing business locally in yen. When the yen weakens against the dollar, their reported sales and profits in dollars get squeezed. It's not about competition here. It's purely a reporting issue driven by the exchange rate, but it can lead to disappointing quarterly results.
We have a couple of specific examples highlighted that show this isn't just about manufacturers.
That's right. The first one is Aflac, ticker AFL.
AFL, the insurance company with the duck.
That's the one. Aflac has a huge, long-standing, and very important insurance business in Japan. A very large part of their earnings actually comes from Japan's denominated in yen. So when the yen falls, the dollar value of those Japanese earnings shrinks on their reports. They're known to be very exposed to yen movements.
That's a clear case. And the second example is Cardinal Health, ticker CAH. That brings in the healthcare sector.
Yes, Cardinal Health, CAH. They have exposure through healthcare distribution operations and partnerships within Japan. While maybe not as dominant in Japan as Aflac is, they still generate considerable revenues tied to the Japanese market in yen.
So even for a distribution business.
The currency matters. Their business involves large volumes, so even seemingly small shifts in the exchange rate can add up to noticeable differences in their reported financial results when translated back to dollars. It just highlights that this yen effect can touch many different kinds of U.S. businesses operating over there.
Okay. Now, the final category of potential losers is maybe the most complex. Certain U.S. rate-sensitive financials.
Yeah.
This isn't about yen revenues, is it? It's more about ripples in global bond markets.
That's right. This is more nuanced.
It ties back to those initial expectations driving the Nikkei rally. The market is betting on big Japanese government spending, likely financed by issuing lots of Japanese government bonds, or JGBs. At the same time, the bet is that the Bank of Japan will keep rates extremely low, staying very dovish. So Japan issues more debt, but its central bank keeps rates down. How does that cause problems for U.S. financials?
Well, that kind of policy divergence, Japan potentially stimulating while other central banks might be neutral or even tightening, can create volatility in the global bond market. It can affect government bond yields everywhere, changing the shape of yield curves.
And why does JGB market volatility matter to, say, a big U.S. bank?
Because major U.S. financial institutions, big brokers, asset managers hold enormous portfolios of bonds from all over the world, including JGBs or instruments linked to them. When global bond prices move suddenly or unpredictably, maybe because of shifts in Japanese policy expectations, the value of those bond holdings on the U.S. firms' balance sheets can fluctuate significantly. It's called mark-to-market risk.
So paper losses or gains based on market moves.
Exactly. It can lead to short-term reported losses or even put pressure on their funding costs if volatility spikes.
And the analysis identified a couple of major U.S. institutions here.
Yes, the examples given were Morgan Stanley, ticker MS, and Blackstone, ticker BX.
MS and BX.
These are obviously very large, sophisticated players. Morgan Stanley, as a global broker-dealer, is sensitive to overall market stability and trading conditions. Blackstone, being a giant in private equity and alternative assets, relies on relatively stable funding markets for its deals and operations. The idea is that unexpected turbulence originating from Japan's policy path could inject unwelcome volatility into the global fixed income environment they operate in.
Okay, that's a complex link, but I think I follow the potential chain reaction. So we've mapped out the potential winners and losers based on the initial reaction and these mechanisms. Now let's talk about how traders or investors might think about this going forward. What about follow-through? And importantly, what are the key risks to this whole narrative?
Right. In terms of trading angles, the initial thoughts seem to be about using baskets, like those ETFs, rather than picking single stocks, especially for capturing the broad Japan move.
So leaning towards EWJ or DXJ initially.
Yes. And again, highlighting the potential advantage of the hedged one, DXJ, if that core thesis of a weak yen alongside strong stocks holds up.
Because it removes the currency drag.
Correct. Even if the yen just stabilizes at this weaker level, DXJ has already sidestepped the initial depreciation that would have hurt EWJ's dollar return. Now, if the yen were to suddenly reverse and strengthen significantly, that's a different scenario. But for playing the expected dynamic, DXJ seems designed for it.
And beyond the ETFs, for ththose defense stocks like LNT and NOC, what's the trigger to watch for?
For the defense primes, it's really about waiting for concrete news. The initial bump came from the political change and the expectation of more spending. The next real catalyst would be actual announcements. Things like specific budget increases allocated by the Japanese government, details of new foreign military sales contracts being approved, or formal security agreements that explicitly call for Japan to buy more U.S. hardware. Those tangible headlines would be needed to sustain the move.
Okay, makes sense. The whole picture seems very sensitive to what happens with the currency, the yen.
Absolutely. That's the FX stability lens. It cuts both ways. If the yen, against expectations, were to stabilize or even strengthen a bit from here, that competitive edge we talked about for Japanese automakers starts to erode. That would ease the pressure on Ford and GM.
And the flip side.
If the yen weakens even further or stays persistently weak for longer than expected, then those translation headwinds for companies like AFLAC, AFL, and Cardinal Health, CAH, become even more severe. They might face bigger hits to their reported dollar earnings in future quarters.
Okay, so the yen's path is critical. Now, let's spend some proper time on the risks. These market moves are based on assumptions about the future, not guarantees. What could derail this outlook?
Probably the biggest single risk is what you could call policy delivery risk. Meaning the market reacted strongly based on the expectation of big fiscal stimulus, but Takaichi actually delivering a stimulus package that meets those high market expectations might be difficult.
Why is that?
Well, Japan already has a very high level of government debt. There could be political opposition within her own party or from other parties, legislative hurdles, or just practical constraints that mean the final stimulus package is smaller or implemented more slowly than investors are currently pricing in.
And if the stimulus disappoints?
Then the main reason for the Nikkei surge gets undermined, and you could see a pretty rapid pullback in the market.
Okay. Policy delivery risk. What else?
Then there's always the risk of a central bank surprise, specifically from the Bank of Japan.
The BOJ doing something unexpected.
Exactly. The market assumes they'll stay extremely dovish. But any hint, maybe even just a comment in a speech, suggesting they might rethink that path perhaps because inflation picks up unexpectedly, or maybe there's political pressure to stop the yen from weakening too much that could instantly change the currency outlook.
Which would mess up the whole weak yen part of the story.
Completely. It affects the automakers, the travel companies, the yen earners. Given how out of step the BOJ is expected to be compared to other major central banks like the Fed, any signal of convergence could be quite disruptive.
Right. And one last risk.
It's simply the risk that comes with such a fast initial move, reversal risk.
Just because it went up so fast.
Yeah. When a market jumps 4 or 5% very quickly to new highs, it creates a situation where people are sitting on quick profits. If something else happens globally, maybe signs of a slowdown elsewhere, or renewed worries in global bond markets, investors who jumped in on the Takaichi news might rush to take profits. That selling pressure could cause a sharp retracement, erasing some of those initial gains just as quickly as they appeared.
Okay, so policy risk, BOJ risk, and reversal risk. Got it. This seems like a pretty thorough look at how this political development in Japan connects to potential trading ideas and risks for U.S. stocks. Just to quickly recap the main threads, the leadership change sparks hopes for stimulus and expectations of a weaker yen. That tends to benefit things like Japan ETFs, especially hedged ones like DSJ. U.S. defense firms, L&T, NOC, expecting orders, and maybe U.S. travel platforms, BKNG, EXPE, seeing more tourism.
Right. And on the flip side, it creates competitive challenges for U.S. automakers, FGM, and those painful translation headwinds for U.S. companies earning a lot in yen, like AFL-CAH, plus that more indirect risk for some financials, MSBX, if bond markets get choppy.
Okay. And you had a final thought for listeners to mull over.
Yeah, just something to consider longer term based on all this. If we do see this persistent divergence where maybe the Fed or other global central banks are tightening policy, but the sum in Japan stays firmly dovish, as the market expects, what does that really mean for the relative value of DXJ versus EWJ over time?
The hedged versus the unhedged ETF again.
Right. Does that ongoing policy gap make DXJ, the hedged one, structurally better because it constantly insulates from a potentially weakening yen? Or could there be other, less obvious effects where maybe the unhedged EWJ finds advantages in that environment? It's a complex valuation question that goes beyond the initial reaction. Something to think about.
That is a good point to ponder. Okay, before we wrap up, we absolutely must state clearly, this discussion is not financial advice. It's not a recommendation to buy or sell any specific stock, ETF, or any other security we've mentioned or even implied.
That's right.
This conversation was purely about conveying the analysis and the opinions that were presented in the material we reviewed for today's show.
Absolutely. Just exploring the potential market interpretations.
So thank you for walking us through all that.
My pleasure.
And thank you, our listener, for joining us on Breaking News to Trading Moves. We appreciate your time.